Hello and welcome to week 6, video 2 of Retail Management BUS302. This is our retail strategy and financial outcomes. And as I said in the last video, I am super excited about this week's topic because as a CPA, I really get excited about the financial side of things and seeing how everything ties together. Now, in the first lecture, we looked at the profit margin and profit margin approach, right? Where you're looking at both the net profit from an income statement and the asset turnover and return on assets from a balance sheet, right? So as you go through as a retail manager, one of the things that you need to do is say, okay, what are our objectives? So this is, again, part of the strategy. So as we're setting our strategy, we not only need to understand what those numbers mean or understand what those numbers are, right? What our profits are and everything else. We need to also say, okay, here's our performance objective. Here's what we want as a gross profit margin. This is what we want as a net profit margin. This is what we want as an inventory turnover, right? So what we need to do is set those performance objectives, communicate it to management, right? And those things should, and also say the time frame for the next year, next 6 months, right? And then we commit resources to achieving those, right? Now, how does that work? So when we start setting these objectives, where do they come from? Well, there's two ways you can do this. You can do top-down planning, which means your boss is saying, hey, this is what you need to do next time. So we take it from the top and we go down to the lower levels. Or this is where you can use bottom-up planning, where the manager says, hey, this is kind of what I think we're able to do. And so from the lower levels, we move them up. And then at the very top, we gather all the data and then put it together for the company. So these are the two ways that we can do it, either top down or bottom up. Which one works better? To be honest, neither one's perfect. They both have strengths and weaknesses. It's whatever is good for your culture. I encourage people to try and communicate with both, where top management and the store level management need to communicate, because ultimately when we start talking about being accountable for the performance, right? If we're going to hold our business unit or managers accountable, in other words, if I'm doing this as a top down, the CEO, and I tell my manager in, Springfield, Illinois, hey, this is what you need to do. If they're going to be accountable for it, if they're going to be accountable for revenue, expenses, cash flow, right? They need to have some buy-in. And if I'm just telling them what it is, then they might not buy in. So if they can communicate and we can dialogue about that, there's more ownership, right? So, and as we go through that ownership, then if they feel like, hey, this is something I can really do, then they tend to be more, they buy in and they're willing to be and say, hey, I appreciate this, and then we can actually work together on this. So now, obviously, you can use these performance objectives. These can be used to really pinpoint problem areas, because if you miss one number, you can say, okay, this number is based on this, so you can track it to where things that you need to do. Now, and it can also help you see things that you just didn't know about. Unpredictable circumstances are like surprises. It's a huge area. So when we start setting these performance objectives, they're really important, and they can highlight a lot of things about what's going on within the company. Right now, as far as which single performance, right? We mentioned last time, should you use ROA or should you use profit margin? To be honest, there's no. Both of them are going to do great. They're going to help you, see how you're going to manage and everything else. But there's no one single measure that says, hey, this is it. This is everything. There's not one single ratio to use to say you're doing a great job, right? Everything is dependent upon, maybe the level. Did you use a top-down planning or bottom-up? How many resources did the manager have at their disposal to really impact that? There's so many different areas that you need to consider. So there's not one single measure, but the more you can pass on, and the more you can dialogue about that, the better off you're going to be, right? So again, our output measures, so types of measures when we start looking at this. So our output measures we can use to assess how we did with investment, productivity, really help us determine how efficient we are, using our resources. Productivity measures also help us compare stores against them, one against the other. So if we have one in Springfield, Illinois, and one in Springfield, Massachusetts, right, we can compare those two stores based on some of those productivity measures. And then input, how many resources are allocated. We can use input numbers as well. So, hey, we gave you this, right? So based on then outputs. So there's a lot of different ways to measure your performance. And at the level of organization, here's some thoughts, right? So the output would be net sales. That's an output measure. The input would be the square feet of store space or selling space, right? The productivity would be return on assets. So this is how we would look at these, right? At the very bottom, as we start looking at merchandise management measures, right, we can look at, okay, we still have net sales, but now we're talking inventory level. How much, what was the level of inventory? What about our markdowns? Gross margin to markdowns, growth in sales, right? So there's a lot of these things that we can use to measure our performance in a lot of different ways. So it depends on what you're really focused on. Some other things as far as store operations. Again, net sales, we can use that as for store operations. Again, square feet, number of net sales per square feet. We can look at gross margin, right? That gross margin is when we start looking at that, maybe we want to look at our utilities or number of sales associates. There's a lot of different things that we can measure. And so as we do that, it helps us. But again, you have to set these measures. You have to set the goals, because if you don't have a goal, right, then how do you know if the stores are performing well, right? So this is really, and when it comes to financial things in business, we do measure ourselves generally with finance items. So when we start looking at this, right, that corporate performance, when we're talking investors are looking at corporations saying, okay, well, how's this corporation doing? Some of the things you'll hear in the business news, comparable store sales growth. So if we compare this particular store to others that have similar things, how's their store sales growth going? Or same store sales growth, right? That's an important one. So now we talk about our same store sales, right, as an average. That's an important one. Merchandise management, lower pricing, being able to control our costs, right, cost of goods sold, sales per square foot, sales per employee. These are all really important performance objectives that we would use for corporate level and those things. Some things that some performance that can't be assessed accurately, right? There are things that are hard to assess, right? Because we're looking at one particular store. So some things that we can do if it's unique, if it's one of these areas that doesn't work real well, is we can use benchmarks. And that's where we compare ourselves to we have a competitor that we're comparing ourselves to, and we look at that over time to say, how are we doing over time? In higher ed, we would do this. We do this a lot, where we compare ourselves to other schools that are similar in size and everything else to see how we do on graduation rates and placement rates and things like that. Because we can say, hey, we graduated 90% of our students within 4 years. That sounds pretty good, but when you have to compare yourself to other schools, otherwise it's just a number. And until it's compared, you can't really say whether it's good, bad, or indifferent. So that's where you would use a benchmark to do that. Okay, continue on. Let's talk about setting prices. Now, setting prices is one of these things that it can be somewhat, like how do companies actually set prices? I mean, it's one of those things we worry. Well, at the very basic level, right, we need to understand that the price of a product will determine how many units we're going to sell, right? And so we need to test and see, okay, well, how sensitive is the price to, the demand to the price. So when we start looking at that, so if we lower the price, demand should be higher, and if we raise the price, demand should be lower, right? So what we often talk about when we start looking at price sensitivity, we talk about price elasticity. So this is how much the change in the quantity. This is going to be change in quantity sold divided by the change in price. Now it's either going to be inelastic or elastic. Okay, so if we have products that have an elasticity of less than 1, okay, that means that we can raise the price and people are still going to keep buying if it's less than 1. So that's inelastic, right? So if it's inelastic, the price doesn't really affect the demand. If it's elastic, the more we raise the price, the lower the demand goes. So those are the things that we want to think about. So depending on how sensitive prices are, then to how sensitive demand is to the price, right? That'll be part of the things that we need to worry about, especially in times of inflation. So right now we are in a period of time of inflation. So as prices are going up because of inflation, we need to really consider how much demand is changing. How, are people spending less on certain things because the cost is going up, right? So as we start thinking about that, that's the first thing as we set retail prices. How sensitive is the price to how sensitive is consumer demand to the price? The other thing that we need to think about is competition. What is it that the competitors are doing with prices? And so as we start thinking about that, do we want to be the lowest price, or do we want to be, aren't we worried about that? Do we want to be the same? So depending on where competition's at with pricing, that can affect our choice of price. And then we have to look at the services where, the price of the service, right, match the supply and demand. It's hard because when we start talking about customer service, customers want to base how much they pay based on what they perceive as quality. And so if we don't charge a lot for our services, customers might think, hey, this is going to be crappy service. But if we charge too much for our services, customers will be like, yeah, it's not worth that. So that's really one of those areas. So when we start thinking about pricing of services, we do need to, again, try and match our supply and demand. But we also need to think about what the quality of the service is and what people are going to perceive. I see that quality, price and service areas in higher ed where for some reason people think that, hey, if I spend more on an education, it must be a better education. That's not necessarily the truth. So that's right. That's just a perception. So we need to really focus on some of these things and think about pricing. So how do you set the price? Well, a lot of companies now are using analytical tools, right? So using analytical tools, we can set our price based on our costs, where we're going to have a certain markup. We're going to mark up our products by a certain amount. So markup percentage, that's the retail price minus the cost. Then we divide by retail price. We might have a certain key area where you want, everything needs to be priced a certain area. We want to keep a certain markup maintained, which means, hey, we've got to factor into our markup any price reductions that we're going to take in the future and any shrinkage. And shrinkage is this unaccounted for loss. So whether it's theft or we miss some markdowns or something like that. So we need to be aware of those. So we might need to build some of that into our pricing. All these things get into areas. So how does this work? So the cost of the merchandise is that green area. It costs us 60 cents. We want to maintain a 30-cent markup. And we know that we're going to have 10 cents in reductions. So initially what we do is we price our product at $1. And so our initial markup is 40%, but we are going to maintain, we aren't going to go below that 30 cent, that 90 cent area, right? So that 30 cents is really what we're looking at. That so essentially we'll have a 33% markup overall. So that's the 30 cent. That's what we're going to maintain, and 30 cents divided by 90. So that's our maintained markup, but our initial markup is 40% because we would take the 40 cents that we marked up, the initial price of $1, which that minus the 60 cents, that's 40 cents that we make divided by $1. That's one way to do it. Another way we could look at break even. So we say, okay, well, how much merchandise should we sell to break even? So we calculate a break even point. That means we need to know what our fixed costs are. Now, fixed costs don't change. It doesn't matter how much we sell, they're always going to be the same. Fixed cost really for in retail, you're talking about your building and any management salaries, utility costs, those kind of things. Those costs never change. We subtract by our variable costs. Now, variable costs do change with the number of units sold, right? So those number of units sold, that a lot of times is your cost of goods. So you need to think about those. So when we start talking about break even, you need to think about your fixed costs versus your variable costs. And then what you do is you figure out, well, how many units do I need to sell, right? So that would be another way to do it. You can also then use price optimization software. These will use algorithms and calculate things. They look at competitors' prices, they estimate relationships, they determine the optimal price and timing of markdowns and everything else. I have seen more analytical tools based on optimization here recently. The example I have is I was online and I saw some Dockers and I was looking for some black Dockers and everything else, and I saw some priced at $15, and I was like, wow, that's incredible, because they were brand, the name brand Dockers. Like, that's a great price. And so I quickly went online to buy some, and what I found out is they were on a specific size, and so that size was not anywhere close to what I could wear. And the size that I could wear was the normal price, right? So when we talk about optimization software, it optimizes the price based on even sizes and everything else. So that is where we're getting to today on some of these pricing areas. Now, again, these are using analytical tools. Because we can compare a lot across a lot of retailers and everything else based on the internet, you're seeing fewer differences in price because we can compare. The mobile offers through apps tend to be the same as your stores. Geofencing could be, that's where maybe it's for certain retail area. We price things at that. But at the end of the day, we can collect information. So we need, as retailers, we need to be aware of that and really focus on making sure that we have the correct prices and everything else. And with that brings us to the end of our second lecture video for week 6, where we're talking again about our financial, how our strategy affects our financial objectives. We'll pick up with this topic in our third lecture video.